I guess I should start by letting everybody that's already on right now that we're going to wait just a minute for other people to be sort of top of the hour, and we'll be kicking off here shortly. Okay, well, I'd like to welcome everybody to the REOC Juniper Square webinar series. This is our first in a series. We've partnered with Juniper Square for a couple of reasons in the context of doing this series, is because REOC's mission, as many of you know, and I better should start off that I'm David McWhorter Mack with the Executive Director of REOC. And so I'm just going to give you a quick overview of why we've come together for this series. You know, as many of you know, our mission is to accelerate the development and adoption of workflow best practices in REOC partnership investments. And what we mean by that is most REOC partnership investments, investors invest in partnerships with real estate operating companies. That typically involves them committing or having an oversight manager, investment manager, and then an operating partner in a tri-party relationship between the investor, operator, and manager. So that's what we have today in terms of you know, our panelists. And then relative to Juniper Square, you know, they're on the front edge of, you know, workflow best practices in investor reporting and capital raising. So it was a natural partnership between the two of us to work on this series together. So with that, I'd like to introduce Lou Jacobsohn, who's the moderator, and introduce his panel. Thank you.
Thanks, Mac, and good to have everyone on the line joining us today. So what we'll do now is introduce the panelists, do a brief overview of the agenda for this session, and then kick it off with the questions. So joining me on the panel, we have Cecelia Chen, an investment officer at the Seattle City Employees Retirement System, where she leads real estate and real assets investments. Cecelia sources and monitors investment manager relationships, conducts investment and operational due diligence, models fund risk, presents investment recommendations, and she also is responsible for identifying and maintaining technology solutions for the investment team. Also on the panel is Scott Stuckman, an executive managing director of the Global Investors Group for Usaa Real Estate. Scott oversees the implementation and management of investment strategies for funds, separate account investments, investor relations, and capital raising activities. He's also a member of USAA's executive committee. And lastly, on our esteemed panel is Russell Dixon, President and CEO of RedHill Realty Investment Management and its related companies. Russell has held key positions in national and global companies within the investment and institutional real estate arena, and he is a leader nationally in the multifamily business. RedHill itself is a nationally recognized investor, developer, and operator of institutional multifamily properties nationwide. So as you can see from the panel, we have an institutional investor, an institutional manager, and also an operator. A nice blend of panelists for the session today. And with regards to the agenda, we're going to focus on three kind of main topics. So what are some of the insights to the unknown and managing the unknown? And with the unknown, what aspects of the REOC partnership model are under stress, and how can these organizations build resilience into their organizations for partnerships in the future? What's the current state of capital raising and how might it evolve? And lastly, how is relationship management changing with respect to communication, reporting, and transparency? So the first question, I'll kick it to Russell to start off, but it does apply with varying perspectives to all of our panelists. But Russell, with the unknown impacts of COVID-19 and you know, even more recently, things like natural disasters, wildfires on the West Coast, hurricanes and flooding in the central and east regions, how are you managing all of the kind of unknown around these events?
Well, each one of them brings, of course, a different approach, whether you're dealing with climate change in the Pacific Northwest, or you're dealing with COVID issues. But I'd probably address my remarks primarily to the COVID side of the equation. I listened yesterday to Gregory Daco at the NMHC. He's the chief U.S. economist of Oxford Economics. I think he echoed the general feeling of our particular group in that we believe that we've peaked on the COVID front. The curve in the U.S. is on a downward slope. So the extent of the negative impacts on the broader economy still remain uncertain, and the risk of a prolonged downturn, of course, is real. But our major concern still is excessive unemployment. We're seeing some defaults surging on the business front, a lot of corporate debt accumulating. I think Daco's main point was that we don't see inflation risk, perhaps some deflationary risk. But all of that is being counterbalanced in the multifamily sector by extraordinary amounts of capital and interest in acquiring this particular asset class. And once you are in the operating side of this business, you recognize that there are a lot of issues that we have to address in the operations. We can talk more about that as we go.
Great. More specifically, around some of the fundamentals for the apartment markets, what has changed as a result of COVID-19 in the last 6 months, and what are some of the relevant stress points affecting investors and managers from your perspective?
Well, there have been some fundamental changes. Of course, we've seen some, and it depends on a market. It's market by market dependent, but we have seen some reduced demand. More people have been allowed to work from their homes. Therefore, they're moving to lower cost markets from high cost markets, moving to co-living, reducing overall demand in certain cities like New York and San Francisco. We're seeing a migration shift, I think, to some extent. High density markets are especially impacted with reduced demand as renters shift preferences to suburban locations. This could be exacerbated in the winter months if restaurants remain closed, inside dining, and of course we're seeing that loosen up. Employment is a major fundamental. This increased unemployment market that we have observed with the rates in areas with high concentration of service and travel industries such as Las Vegas or Orlando has dramatically affected occupancy and collections. Supply deliveries are still expected to be consistent with many projects underway, but there are new projects that will be delayed as breaking ground due to market uncertainty. So I think certain markets with the employment bases that were not materially impacted by COVID are continuing to experience uniquely rent growth. For example, Phoenix and Salt Lake City. And I would just probably conclude by, I think that the greatest, if you were to take the multifamily sector and divide it up into the three classes, A, B, and C, the greatest impact has probably been on workforce housing and the C category. The A category, which is the core plus or core category that typically there are higher rents, has been affected fairly dramatically. And then the B product, which I think has been the most resilient and seems to be fairly stable today.
Perfect, thanks. Cecelia, for you and your organization specifically, with all of the unknown impacts and some of these more recent kind of climate events, how do you and team think about or start to understand your portfolio risk, to understand what the occurrence of something might be on your broader investment portfolio?
Yeah, well, first and foremost, we do want to indicate that we're very long-term investors, and when we do the due diligence on our investment managers, once we do like their process, we intend to be with them. And for black swan events like the pandemic, we believe that it's something that we coming into this, we already knew all the trends against retail towards industrial, but what happened really in the pandemic that exacerbated some of these trends was really out of anyone's guess. And we still believe that as long as we are with the best operators and best managers in these markets, that we are willing to come through this together. That said, part of our due diligence process in risk mitigant is making sure that our managers have thought about the different risk scenarios and have modeled their portfolios with respect to how the different sectors, geographies play together. Some of our managers have used third-party climate assessment companies to really model out, for every asset that they hold, what are the risks, just in terms of a score towards fire, towards flooding, towards extreme weather events, just so that they have an awareness, and that awareness helps to lead to better portfolio construction. There's still going to be a price for properties on the Miami coast, but the awareness helps them price it better. And finally, I think a lot of that then comes down to how the managers track and are able to report on some of these data that they are considering. Because now if we're asking them to consider the weather effects, but we're also asking them to consider all these other factors, ideally they have a good system internally that communicates both with the operating companies and with us, the investors.
Great, thank you. Scott, over to you now. With USAA having such a wide range of investment strategies at its disposal, and then of course with the occurrences happening, how has your and your team's focus shifted in this respect? And does COVID-19 remain at the forefront for you and team, and are events like wildfires impacting investment decisions at all?
As it relates to wildfires, I don't think that's really been a big influence on what we're investing in, because we're not tending to be in the areas that have been wildfire vulnerable. I mean, it really hasn't affected the main cities and suburbs. It's really been more rural areas and the overgrowth of the forests, et cetera. And you combine that with climate change, et cetera. But I think there's a blend of both those factors that are kind of showing themselves out. To COVID-19, clearly that's been a part of our discussion. And how does it influence the type of properties we would have? For example, let's take senior housing. Senior housing has been hit extremely hard, as we all know. And yet the demographics still push senior housing as a real and needed product type as we look at the future and the numbers, the masses of numbers that are going to be needing senior care, and the ratio of diminishing caregivers relative to the increasing number of seniors from I hate to say my generation, as they continue to grow, from the baby boomers. So the baby boomers are just a much larger number than those in their 40s now. And so that collective senior housing market has the real demand. Clearly it has to pivot in how it's handled its business. Clearly it has to up its game on how it operates. And clearly existing older product may be at risk, as an example, because it isn't designed for the type of security, the type of separateness, the type of communal living that senior housing would have. So I think we're looking more at, and we think it's a great opportunity still, but we see it more on new development as opposed to rehab of old. And if it can be rehabbed, it has to be of a certain type of bone structure, et cetera. That's an example for, and not that senior housing is our main trump card, but it's clearly on the horizon of housing that we would be looking at. So operators in that area are clearly of interest to us across the market.
And is that, can you kind of shed some light on when that shift has occurred in kind of your investment strategy to focus on that area?
Yeah, well, so the COVID-19 really brought it into focus. We've had senior housing on our radar and on our plate for some time, but we've really started to push forward about a year ago. And fortunately, we really didn't get much into it. We had to pivot. We've paused, and now we're going back out again. But we think we have we've done a lot of analysis. We're continuing to, as we're all learning still about this whole COVID-19. And frankly, it's not just a COVID-19 experience. I think I use the analogy that in LA, there were the earthquakes, and I lived through those being an LA resident for most all of my life. And there was a time when no one was going to buy anything in LA. certainly not in the San Fernando Valley. Well, fast forward about 5 years and it's one of the hot markets again and has been since. People get over it. But part of it is that everything had to be seismically retrofitted. Everything has to be seismically inspected and up to snuff in order to be able to be investable, insurable, and or in the new developments, the construction details are much more rigorous for seismic. I think the same will happen as it relates to the virus factor, because people are talking about, and this, we'd be naive to say, hey, this is a one-time thing and it's a black swan event, it's a 100-year event. We now have seen it, and our generation will be constantly aware of it in the years coming ahead. So I think people will start looking at, is it a pandemic resistant building? And that would, what does that mean? Things like air quality, air handling systems. And I think that the ability to isolate your air handling systems and or purify your air handling. I think there's going to be a boom in the industry that provides air handling systems and purification of air. So all those factors, I think, will become a part of our day-to-day life going forward, just as seismically conditioned buildings are in Southern California.
Perfect. Russell, we could play on that thread of the development and new developments and the changes that might occur due to the pandemic. So kind of interested to hear your perspective on that, but then also for your existing portfolio and the pandemic related challenges, maybe to understand your perspective, with the context of like the impact of rent relief, the impact of the extended eviction moratorium on your own operations and what you're hearing from peers, and how does it play out in the market?
Well, I think I'd break that up into the two. The development front, I'd make one comment on that. And, we're not a major developer, but we work, on the construction side and partner with developers, et cetera. On the developing side, I think it's important to understand that, first of all, the U.S. is undergoing a tremendous rental housing and affordable housing crises. If you took the NMHC numbers and looked at the number of units in the U.S., I suppose that would be somewhere in the 38, 39 million range of institutional grade apartment units. Of that supply, we know that 1% of that becomes functionally obsolete on an annualized basis. We're not keeping up even with the obsolescence, with less than 1% of new product being built in these numerous locations around the country. And yet you have 5 to 6 million new renters coming into the market, the grain of America, renters by choice. The fact of the matter, and of course, workforce housing, which is extraordinary, which now is also integrating a very important part of our culture, which is diversity. So development is going to continue, and I think the major shift there will be, as mentioned a few moments earlier, from some of the major cities. We know that the gateway cities now have lost a significant amount of their luster, and so I think a lot of the development will be taking place in suburb locations, but it will continue much more sensitively so as as various developers evaluate supply in some of these major cities like New York and Los Angeles and San Francisco, et cetera. As a major operator, to your second question, some of the perspective regarding the extraordinary challenges that affect the operations side. You mentioned specifically in the context of rent relief and extended eviction moratorium, et cetera, on operations. Fortunately, I'd say that the rates of collections and occupancies have remained higher than we initially expected when the pandemic exploded, if you will. I think the National Multi-Housing Council is probably the best source for tracking rents through their rent tracker program, but I think they're showing collections in the 93-94% range. That's a significant number when you see occupancies historically at 95% levels, for example. RedHill's numbers are very close to the NMHC range with occupancies at somewhere between 94-95%, and our collections at 92-93%. So paralleling what the NMHC is showing in the rent tracker program. We do have, I mentioned to begin with, that the workforce housing category has, is hit. And we do have a property in the Pacific Northwest. We have an institutional partner on that. We're partnered with PIMCO, and that particular property is 94, I'd say 94% occupied. And in the first part of the month when rents are due, we're collecting 78%. Collections are at 78%. By the time we get to mid-month, we're probably at 80, 82%, and we're getting 88% collections on that particular property. So this workforce housing is, we're off. But if I were to categorize the numbers, we're probably 100 to 200 basis points below the prior year, and I think that's pretty significant. The eviction issue, I mean, it's very real. It's going to continue to be maintained. We're obviously working very closely with our residents in our properties, trying to provide services, trying to be patient, guiding and directing wherever we can, part of the RedHill family. And so we do all that we can do there. And Washington, California, Arizona, many of these markets that we're in, the various municipalities have various and sundry regulations that we have to understand and live by. So it varies dramatically by region as to how we're trying to work around some of the challenges on the operating side. I think the good news is that our occupancies for all that are on this panel and the call, I think everybody in tandem would agree that occupancies are still strong. Collections fairly, doing, I think, very well in the overall scheme of things. And of course, we're going to watch very carefully the unemployment situation going forward.
Great. Appreciate the perspective. Since this is a REOC panel, and Scott, USA has a number of partnerships, would be interested to hear from your perspective how USAA's approach to REOC partnerships has changed over time. If there's any stress for the partnership model, what are you guys experiencing? And then maybe for the audience, share a little bit about how and when USAA decides to partner and how they evaluate potential partnerships.
Sure. I'm not sure anything about the recent events have changed our approach to our partnership relationships. We as a firm have always worked with operating partners. We've never been a standalone. We've bought properties ourselves. We've rehabbed some properties ourselves. But generally speaking, on any development, any extensive rehab, we always have an operating partner. We've always valued that significantly. We have many repeat relationships, numerous programmatic relationships. Of late, what we've done in a couple of cases actually, have actually made investments into the entity level, where it's been an entity level investment with them and going forward for a specific product specialty or regional specialty that they have. That's not a requirement. Sometimes this helps though when we're looking for co-investment, pari passu relationship from an operating partner who may not have the capital to do the scale of what we're looking to do. The way we augment that is, well, how about we invest in you, and then we can do it alongside you, and our alignment is even more pure. So that would be the only thing I'd say that has meaningfully evolved, because there's been more need for that in the last few years than there was perhaps 10 years ago when it was much more fragmented. We have a significant housing program initiative, which is all things housing, from anything in the housing arena. And part of the model there is to align ourselves with significant operating partners in regions. In one case, a national operator who has a certain niche that they'll do. We don't want to have operating partners who are rushing to register, where it becomes counterproductive, and it's frustrating for them, and it sets us up for failure because we're having to be referees. We really like to have our partners share the same passion we do for our partners in our relationship. We're the largest investor in most everything we do, we as a firm, as partners. So it's not like we're trying to just get AUM under management. So the alignment with our operating partners is very pure. We're both seeking the same thing. Some operating partners want to stay in long-term. The majority want to have a capital event at stabilization. We're flexible either way and have structures for both ways. Because again, we're looking for the ultimate outcome. And again, we look at it as we're investors first alongside them as operators. And then we make decisions based on that, not on trying to secure asset management fees long-term, which sometimes can cause stress for the operating partner who's trying to move forward. And that was the other half of your question?
I think you covered it, just around, how and when do you partner, and then the evaluation of potential partnerships. So
Evaluation of potential partners is, we've been very fortunate to have some of the major names across the country to be our partners. And we have local acquisitions officers throughout the country. And those relationships often are where we actually create the genesis of those relationships. That we have one thing is unique, I suppose, relatively unique. The good news for our operating partners is they're not dealing with me, a generalist. They're dealing with somebody who knows what he's doing, and in detail. And Russ laughs because he knows me well enough to be able to know that's a true statement. But the reality is, we have a team that's remarkably focused in the multifamily sector. We have the head of acquisitions and development is Haley Golub. She's an architect by training, an MBA, and was a practitioner on the development side for a number of years. We also have a full-time development staff. That could sound like a nightmare to an operating partner going, oh my God, these guys are going to be control freaks. It's just the opposite we found. They really appreciate not having someone like me who is smart enough to ask a lot of questions, but not necessarily all the right questions, and not necessarily to keep the process going forward. Whereas Haley and the full-time development team, construction management team, I should say, works hand in hand with the operating partner. And the operating partner can talk quickly and in shorthand and get things done because they're talking to really smart people who really know their product. And they can get quick decisions made and keep things moving forward for the benefit of the project.
I'm laughing because you are, self-deflating there, but you're one smart guy.
Well, smart enough to stay out of it.
Thanks, guys. Cecelia, next to you, I think building resilience into your investment strategy is a common theme that we're hearing today. When you're looking at potential investment managers, what are some of the attributes of a resilient portfolio that you're seeking?
Yeah, definitely. So we have a matrix that we put together for every manager we evaluate, and it spans both the investment side as well as operational due diligence side. But investment side, it really, we first look at a team, look at the alignment. If it's a very big company and they have multiple products, how much AUM is in each of the product lines, and how is the incentives shared among the team members, as well as how important is that particular product line that we're interested in, how relevant and how much revenue does it generate for the overall company. And then we will look at how well staffed the team is, what is their experience, how long they've worked together ideally, what are their both complementary sets of expertise, as well as how that matches with perhaps physically where they are, and also in terms of, say, sector allocation, who is deployed where. Track record, longevity of the track record, stability of the track record, right? Are the track record all over the place, or are most of the deals pretty close together in the final returns? What's the original underwritten returns versus the achieved returns? These are all factors that we will look at. And then for certain types of funds, such as core funds, we will also look at portfolio construction. What is the portfolio manager's approach to putting together that portfolio? And also, how do they perhaps work with internal research teams, as well as the bottom-up information in putting together a portfolio that's diversified, yet still aligned with the future. So that's, targeting, looking at demographically, as Russell and Scott alluded to, where are the population's preferences shifting? Where are the migratory patterns? Where are there a lot of new supply coming up and perhaps fewer needs in that particular place? So all that combined together. And then of course on the operational sides, it's more the reporting structures, the evaluation process, how long the service providers like auditors and administrators have been used by the fund, etc.
Great. A couple more kind of questions on this topic. Russell, for you and RedHill specifically, and the concept of ensuring durability for your portfolio. You know, what has been the impact on cap rates and general kind of buy sell side activities that you've experienced?
That's a very interesting situation I think that we have today in the multifamily space. Everybody on the panel knows there are significant amounts of capital on the sidelines, given the fact that capital is coming out of other sectors, so significant capital. The rates in the market at the lowest rates historically that we have seen. The fact that gateway markets, as I have mentioned, are somewhat under distress. And then we have cap rates that seem uniquely to be benefiting from a lot of the conditions in the market. So it's very dynamic, and that kind of a question is always best answered on a market by market basis. But we do believe that that some assets that will have to be elongated holds. Most people, you know, in our sector that expected distress may have been sorely disappointed. There's not that much distress. We're obviously investors and operators have to be very focused on operations during this time. We, in our particular group, when we are partners and we own a property, we go through the process of establishing a value on a quarterly basis with market to market, and would ask the question, is it time to sell based on the mandate of our partner? We become sellers when the market's underwriting assumptions are more aggressive than ours. There were a few buy-side opportunities out there during the time that perceptions were more negative about the future. We don't see that kind of off pricing. We have estimated in some cases, and in some markets, pricing could be off maybe 5 or as high as 10%, depending on the asset class and location. We recently purchased a property in Phoenix that we put under contract in April when COVID was creating some uncertainty in the market for many buyers, and based on the exceptional performance of assets we owned in the market, we were confident in our underwriting, and we were able to buy in a market that just 6 months previously had been too hot to find value. So we purchased the asset at a 5.25 cap rate. That cap rate would trade today probably at a 4.25 to a 4.4 rate. This translates to maybe a 15% change in value over a few month period of time. That cap rate, that 5.25 that we acquired it for, on a stabilized basis is probably a 6. So that was an exception to the rule. I would comment that if you're in the market, if we're in the market today, these competitive bid processes are highly competitive, or fittable deposits going up. Cap rate compression has somewhat been abated, but is at least holding its own. So that would, I think that would probably be the appropriate summary. I'd be interested in Cecelia and Scott's observation on the cap rates and some of the activities that they're seeing on the buy side.
I'm happy to toss in I think, you use the term exception to the rule. I think everything today is an exception to the rule because there is no rule. I think the biggest challenge is where is everything going? Where's everything been? And I think the shock and awe is past. I think now it's a matter of how do we migrate through this. I think there's also, frankly, a little bit of pause and caution just based on the election. Depending on which way it goes, there's significant changes in how legislation might impact a landlord in today's in the environment in November or December, or whenever they finish counting all the ballots. But whenever that determination comes in, that's a factor that people are looking at, I think, with some sobriety as to what does it mean. But I think these are all seen as temporal, so they're all exceptions to the rule. I think the rule will, the industry has always been adaptable. It just says, just tell me the rules so we know. Right now, there's uncertainty as to what the rules will be in 3 months. So there's a little bit of trepidation there. I agree with your valuation drop of 5 to 10% on those things that have happened, but it's just been so little trade. I think, so that's been another factor. But at the same time, we're talking about multifamily here. We deal in all product types. Multifamily still is, next to industrial, the darling of the industry right now. And it's necessity. People have to live somewhere. How they live has changed a little bit. The impact of where they live has changed a bit with the introduction of, on the one hand, it's sort of the tale of two cities. And I think the future has been fast forwarding, a 5-year evolution of technology and remote officing, et cetera, and virtual from home, working virtually. We're supposed to take about 5 years to become adopted by many. I, for one, never did a Zoom call in my life prior to this, but now I live on it like all of us. And so from 5 years to 5 months, it suddenly has become the way we live. Whereas valuations have been put on pause, basically. Just no one knows what valuation is. That has not been moved forward. It's been put on sort of a complete pause. And people are just sort of navigating intermittent transactions, is my feeling today. It's just sort of hunting and pecking for an opportunity that fit some broader picture of what they're doing. But I think it also bodes well for development because a lot's been on pause. If you have conviction on a location, if you have a conviction on an area where you think the future of living, which will be people want more space so they have an office to work from, when they can go further away. They don't have to be in a 600 square foot, 500 square foot space at $4,000 a square foot to be close to the office because they don't have to be in the office every day. So maybe they can go out to the burbs and come into the office 2 days a week. So I think that's going to be the combination blend that may come in 2 to 3 days. They come in 3 days a week in a row. They figure I don't have to commute every day, so I can have a little more life somewhere else outside of the city and at lower cost. Those are the dynamics I think we're dealing with a lot as investors and creators of space for housing.
Yeah. And as everyone kind of identifies any distressed opportunities and wants to strike, you better have some capital on your side. So with that, maybe shifting over to that topic of raising capital, and starting with Cecelia and her perspective. Cecelia, you and team, are you on hold investing now? Or are you continuing to invest in real estate to meet your long-term allocation strategy?
So we have both a rebalancing plan as well as a pacing plan for all the asset classes that we're growing out, of which private real estate is one. In which case, currently, because of the run-up in equities, our real estate portfolio, which is predominantly Odyssey funds, and we're expected to see the NAV coming down over the subsequent quarters, we're expecting to be underweight real estate even more than previously, and that will speed up our pacing into real estate. Also speaking back to the pacing plan, it's something that we deploy for all of our private markets, private equity, private credit, infrastructure, real estate, that we believe once a new asset class is added to our portfolio, we want to diversify our vintage year risk. And so we have set aside more or less a certain amount to deploy every year, but we actually expect, given the current situations, to the extent that we find suitable partners, to speed up the deployment pace slightly. We're also seeing with fund managers that we're invested with, we recently have committed to close-ended funds that still have capital left to deploy. But I agree with Scott that for the most part, it seems like there's been a halt in transactions. There's a very large bid-ask spread. A lot of managers have been waiting for distress that hasn't yet come. Our close-ended opportunistic fund manager that have the flexibility to invest across public and private have actually taken advantage of the discounts in the REIT markets in March and April, bought into several REITs that they've actually exited by June that they are thinking of re-entering at this point, just given how much spread there is between the public and private markets. That's where they are seeing the opportunities. With our Odyssey fund manager and just overall in the Odyssey universe, I think it's also, you know, a factor of the definition of Odyssey and what these managers have to abide by. To be part of the group, at least 80% of the market value has to be in office, industrial, multifamily, and retail. And given that retail is very much in distress right now, office, more of the uncertainty and future impacts of COVID seems to be talked about in the office sector. Very much multifamily and industrial by default are becoming even more of the darling than previously. So, you know, there's just more talk among Odyssey managers in general to increase their multifamily exposure for all of their funds. But then the question comes to how do they, because those are open-ended funds and now a lot of them are getting a longer exit queue, how do they generate that cash to be able to buy into opportunities? And that will come down to if they're willing to hit that not as attractive a bid in the wide bid-ask spread to exit office and retail, or do they still hold on and hopefully, you know, wait for more dividends and perhaps the entry exit queue to balance out of it?
Yeah, interesting. On this topic a little bit, one more question for you, Cecelia, on this, and maybe relevant for people listening. Has you and your team's willingness to invest in a new manager changed during this pandemic and the restrictions on travel and not meeting face-to-face? You know, maybe you can tell us about the diligence process and has it evolved, and what would you like to see happen from that perspective?
In terms of the diligence process, so I also cover real assets, and another one of our new areas is agricultural lands. And because that's an area that we haven't previously focused on, I've started a lot of new conversations during COVID, purely via Zoom. And I personally am extremely comfortable with the process. I also attend a lot of allocator conferences across industries. And, you know, that's something I hear most often from venture capitalists, that they've given out a lot of term sheets to entrepreneurial groups that they've never met. Within the allocator community, from what I've seen, most groups are not comfortable investing with managers that they haven't previously been able to meet face-to-face prior to the pandemic. Although if, you know, they've had prior meetings and we're just finishing up the other parts of due diligence, they are happy to proceed. I think we will still have to come across that bridge when we come to it. It doesn't seem like our team has issues, but we do work hand in hand with our consultant. Both of us report to our board, and I know that our consultants are having hesitancy about recommending new real estate and real assets managers whose properties they cannot physically due diligence. And I think that brings, you know, a different topic, right? We could question what is there to be gained talking to somebody face to face rather than across Zoom, where we can see each other's facial expressions just as clearly. And perhaps if we get everyone in a virtual room, we can see somewhat of their, you know, interaction, which is usually what we look for when we do a in-person office visit. But if we're talking about real estate and real assets, how comfortable are we investing if we cannot physically be there to understand the vibrancy of the area and see, you know, to some extent, the building or the renovation effects? But I think it is a good question for the industry also on how can we perhaps use more technology to show these spaces or show the vibrancy of neighborhoods, or perhaps, we have the data analytic tools out there now, PIMCO, Zillow, right? There's a lot of companies out there that have great databases aggregating everything we usually look at, from walk scores to safety scores to how many jobs, restaurants are in a certain area. And I know Green Street is working with scoring physical properties based on just input address, and they will give you a score of how vibrant that area is. How can we as allocators and just industry utilize that kind of information more so that we don't have to rely so much on physically being there?
Perfect. Scott, you and team are kind of on the flip side of that. We hear specifically that, and we see that groups are continuing to fundraise, but maybe you can share what your team is doing to fundraise in this virtual world, and maybe also share what has changed, if any, in terms of interest from your institutional investors to invest in your open-end vehicles or to create programmatic JVs or separate accounts with your firm.
Yeah, I would submit on the programmatic JVs, we haven't had a problem with new relationship discovery, if you will, and people willing to advance the process. From the investor side, I'm trying to think back. I think we've gotten 2 new investors we'd not had before in the last 6 months. The balance of our dollars have been existing investors. And I think that's pretty much the story of our industry right now from a capital perspective. And it makes sense just because, first of all, as we all know, rightly or wrongly, I guess rightly, but it's frustrating at times how long it takes from first discussion to actually closing. I mean, Dave made a career in this world. He knows how long it takes. Everything is, if your wife asks you how'd work go, just fine. What happened? Nothing. Every day is sort of you just keep advancing the ball, and eventually the most anticlimactic day is the day you actually get the final commitment, and or when you close on a deal, it just takes time. So I think the jury's out as far as, I think 6 months from now, we'll know if people actually got new relationships, because it takes that long, and especially in the tumultuous times like now, to get new relationships. But more and more, we're hearing people like Cecelia saying, hey, I have to keep moving forward. My first 3 months, I wasn't going to talk to new people. Then the next 3 months, they start saying, I guess I need to, because I can't, all of my existing stable of partners or advisors don't cover everything I want to be doing. They're not bad, not right, not good, not whatever. It's just, I need to be doing some other things as well. So people are finding new ways to get comfortable, just as Cecelia enunciated all those various attributes you can go to and all those resources to get comfortable. And then I think there's a lot more referral amongst peers. One thing I don't think Cecelia mentioned that I'll bet she uses is she has quite a few friends in the industry that she knows well and trusts, and would call them. It's the old-fashioned, what do you think? What's your experience been? People will get comfortable in other ways if they have to. And I'm not proposing that's no big deal. I'm just saying I think that's what has to happen until we get back to a more normalized in-person type of experience, which is what we're all been used to in the past.
Russell, for you and RedHill on the capital raising side, you're sourcing capital from kind of 2 distinct groups, right? Creating the partnerships, your institutional capital, sourcing capital from high net worth individuals as well. What has changed from your perspective on the ability to raise capital from distinct investor groups, and is one more attractive than another at this point in time?
Yeah, thank you. Maybe just tag on one comment to Cecelia and Scott's remarks. One of the things that I've really noticed over this period of time, the past 6 months, has been how now our institutional partners are, and many others are, really relying on operators as an investor operator when we're dealing in this environment with closing offices, creating many financial services, to assist our residents, trying to work on the restraints of eviction, the effects of collections, suspension of distributions, where there's so many different variables there that I think that the operator has become front and point to many of the institutional and major investors that typically were investing directly, but now see how critical it is to have someone at the helm that is really dialed in on the operations of a given asset, a community in this case. Relative to our fundraising activities, as Scott and others, David, know, we at RedHill are very actively involved in the process of selecting assets and then appropriately matching them to the mandate of some of our preferred equity partners. Those equity partners are institutions, of course, typically in private equity. Private equity is, I would suggest that private equity and their appetite has not been affected at all in our activities to match capital to varied assets that we see in the market. On the institutional side of the equation, some of our major institutional and preferred go-tos that we have relations with have become much more selective, and of course concentrating on some of the variables that I had mentioned previously. Where is the deal located? What type of an asset is it? What is the story? And what are the prospects in this environment for growth? Those questions need to be answered, and if you can adequately answer them, then you have to address the practical issue of how can I get a team to look at an asset, go through a due diligence process when travel is somewhat challenging, and we have ways to go through that through access agreements and utilizing technology, et cetera. One of the transactions that I referred to, our major decision makers were not on site, and we closed the asset. We have done other transactions with them, so a high degree of trust, but they depended on us as operators to run all of the due diligence traps. We utilize Zoom and video, et cetera. And of course, some of the analysts were able to fly out and see the asset, but some of the major decision makers that normally would visit a property elected to stay at home and support the recommendations of all of those involved. So on the fund side, more conservative, but not out of the market, I would put it that way.
Great. So I'm just doing a quick time check. I think we'll have time for one more question. I'm going to kick it to Cecelia, and then maybe just a quick 1 to 2 minute wrap up from each of the panelists that they would want to share, or that they do want to share with any of the attendees. Last question that I'll ask has to do with kind of managing relationships and this concept of increased demand or the perception of increased demand for information from investors. And obviously that has a trickle down effect to a manager and to an operator. Cecelia, we're hearing investors say things like, you can tolerate bad news, but you can't tolerate kind of no news or slow timing to let you know if something's happening. So maybe you could share what your team is seeing and how your managers are meeting your expectations for the need for reporting and the demand for data.
And I want to use an example earlier that, we talked about multifamily, what is happening in the market. And you guys spoke of rent collection, and that's what most of our fund managers also reported to us. Rent collection is still going well. But as an investor, I really want to know more details, right? I want to know the changes in concessions that you're now giving out, because I know that at the end of the day will hit the operating expenses, but it might not even show up in just the NOI. I do want to know what has been the newest trends in lease renewals, in what are the new rents being struck at, and if the new signed leases have now adjusted terms. I think all these more up-to-date information will give me a better picture both of our current portfolio, a better indication of where our portfolio is going, and perhaps a better indication of, the next manager I speak to, do I think based on some of these trends that I want the new manager to be talking about this type of multi-family asset, or should they be talking about single family like they are all talking about right now? But I don't have that data. I only have the data, for the most part, the headline data in a PDF that the fund managers choose to show me. But I also get that, if all of us allocators ask for too much data, then we're at the end of the day paying for the costs, first of all, of the additional personnel. And it really puts a lot of stress on all the real estate managers, and especially a higher burden relatively on the smaller managers or on the operating partners who otherwise could be sourcing deals. So I think it comes down to technology, to reporting, and on the allocator side, until I have better visualization tools and better platforms that help aggregate all that data, how things change quarter over quarter, month over month, it's hard for me to be able to process all that data as well. So I am very much for platforms like Juniper Square that help to bridge that transparency, but hopefully also at an easier make it all easier for the managers and for allocators like us. And at the same time, I'm also hoping for platforms to come out that could help us better evaluate potential managers, because just as I'm looking for that information from our existing managers, if I'm doing a search and speaking with 20 new managers, that's more data burden. And if, for example, Slovis Top Q has a template, which if some managers were already reporting into that platform, and they can just, allow us to see whatever data they reported, and we will be able to, again, look through the deal by deal, it really facilitates our due diligence process as well.
Great, thanks, Cecelia. So just a couple minutes left. Russell, maybe I'll start with you, and then to Scott and Cecelia. Any kind of one takeaway you want the audience to have as we wrap up the session?
It's a very interesting time, and the foreseeable future it will continue to be. We have an election year impact. We've got climate catastrophe. We have COVID implications. We've got rent control. We've got regulatory conditions. So we're in a very dynamic period of time, as Scott mentioned. But I am extraordinarily confident based on the multifamily sector's demand and the continued growth that we see in the market. We believe that we'll get through this bumpy period of time with little distress, and we'll continue to rely on tremendous partners and working with one another, and we anticipate a very optimistic year to come.
Great, thanks. Scott?
I think it's an old expression, but crisis creates opportunity. I don't mean just in the transactional side, because it's a rather quiet, cautious time. But the opportunity is, and Cecelia touched on it a bit, is I think in stress, when things are going great, a lot of people get away with a lot of things. The demand, when things are going up and up and up, you're not asking for all these details. And the tendency for some is just to coast a bit and maybe not be as rigorous or spend the money on some of the things that when something like this happens, your muscle memory and your infrastructure isn't necessarily prepared for the kind of communication and the kind of collaboration that your money partner and or your operating partner or anyone in the food chain of making this happen, the ecosystem, would like to have. And I think this has been an opportunity for those who have been best in breed at having rigorous internal infrastructure and reporting have been standouts. We felt that our partners have been, to the man almost, all of our operating partners have been terrific that way. We like to think we've gotten a lot of positive feedback from our partners in that sense. So we've been very, very rigorous on that. But maybe that's because we're investors first and we have so much of our own money that we look at it like an investor. But I think for all of us, this time of transparency that Cecelia touched on, and the need to be really, really refine our tools if we haven't already, this will be a chance to prove ourselves. And if you haven't, obviously we have to all pivot quickly. Those who haven't need to pivot quickly to be able to report. Well, they'll have a harder time recovering because people will see them as not the complete, deep organization at whatever place they fit into the food chain that they should be. So I think that's important. It's just make sure that your internal workings are really everything they should be, and you're not just riding the wave.
Right. Thank you. Cecelia, to wrap things up.
We're all in this together. It's at the end of the day still a people business, a relationship business, and we really appreciate all that our managers have done, and especially the operating companies right now, seeing how we cannot travel. Most of our managers cannot travel. And as Russ alluded to, it becomes more of a trust that we have chosen the right partners. And if we have chosen the right partners, then we should also believe in those partners, and together we'll get through this.
Very nice way to end things. So thank you to everyone on the panel. Thank you to everyone that joined us for the session today. And I hope everyone has a great remainder of their day.
Thanks, Luke. Great job.